Hey, it's Dave Britton with Lobo Business Sales LLC. I want to thank you for seeing this video and hopefully seeing the prior one. The questions that we went in the prior video is your business sellable and what is the business worth? Hopefully that video gave you some illustration, but now we come to the question, who is actually going to buy your business? Well, that's a broad question and it can be answered in a multitude of ways. It's really dependent on what the business is, how much it makes, what area it's in, maybe a geographical area, and some various different metrics that people are going to look at. Let's go over those in more detail. One of the first things that a buyer is going to look at is what is the business making? Let's just get that out of the way right up front. Whenever a person is looking at almost any business, the very first question they're going to ask is how much is this business making? Now, keep in mind, a lot of times they're not asking that. They're actually using that as part of their search results. So even to the point of asking further questions doesn't even come along until they know what the business is making. Once that is understood, there's requests for additional information. So when we look at people who are looking to buy your business, it's basically going to be one of three types of buyers. The first buyer on Main Street business transactions, which are normally earning about $50,000 on the low end, some asset sales a little bit lower, and then on the high end, making about $100,000 to $150,000, and these are after debt service net numbers that we're speaking about. Those are normally going to be owner operators that are looking to come in, purchase the business, and work the business as their source of income. They may be corporate downsized where they don't want the corporate environment. They want to be a boss. They want to basically hold on to their reins and take control of their own destiny. Or maybe they just don't want to answer to another manager or a CEO or president. They just want to run their own business. This is a common purchaser in the Main Street arena of locally owned brick and mortar businesses. These are what you see as the pizzeria or the restaurant or the local gym owner. You see a lot of this in the self practices of dentists, doctors, chiropractors, weight specialists, things of that nature. Usually these are businesses that have under 10 employees, and normally even as sometimes it can only be family or self-run. But once again, your individual buyer is one of the buyers that are going to look at the businesses for sale. And normally, once again, this is after the debt service, is going to be about $50,000 to about $150,000, sometimes as high as $200,000 on some of the professional practices. So those are the individual buyers. Then you have the second tier of buyers in the Main Street to mid-market range. And those are going to be higher net worth individuals, partnerships, and trusts that are basically a conglomerate of funds that are looking more for a passive ownership role. These people or these entities are not looking to run the day-to-day operations. So what they're looking to do is deploy their capital in other avenues outside of maybe, say, the equity market, the bond market, real estate holdings, certificates of deposits, etc. They're looking for a rate of return on their capital. Those are going to be intrinsic for their own particular viewpoint. But in commonplace, what we'll normally see is the business needs to have enough sustainable cash flow, discretionary cash flow, to support a manager, an on-site manager, or an operator of that business, plus the debt service, plus a return on that investment. So in that scenario, let's use $100,000 as a top tier manager that's going to run those type of businesses, debt service at maybe another 100,000, and maybe they want 100,000, 150,000 in cash flow coming from that business. So in those scenarios, usually on the lowest end we're going to see is about 250,000 in earnings, and those can go up to about $1 million, a little bit higher on, once again, these are smaller individual and unit family units, partnerships that are normally looking to acquire in that 500,000 on the very, very low end to about 2 to 3 million on the high end. Some will go as high as the 5 million mark, so they can still utilize traditional financing to acquire the business, but it's a little rare to see them go in that level. Usually it's going to be in that middle market. So those are two of the buyers that are probably going to look to purchase your business. The third one is what's known as a private equity group. Private equity groups are categorized in a multitude of fashions. In fact, that's a whole nother video which I'll be putting together. But what you want to understand is private equity groups have restricted covenants in their corporate charters of what they can invest in and what they can't. They are not looking strictly for the cash flow of a business. In fact, sometimes they'll buy a business that's losing money but capturing massive market share and massive accelerated growth. They're looking for the hyper growth companies in the very, very early stage that are past a seed level, past a proof of concept level, and are actually getting into their first wave of growth. So these type of buyers are looking to acquire highly growth companies. They're normally paying higher multiples than the average individual worker or the individual group that's looking for passive income, and they're looking to scale that business or grow that business. Now, each private equity group is going to have a different exit strategy that they're looking for down the road. But in a nutshell, most of the companies are going to be looking at anywhere from 36 to 60 months to grow the company. Some is in the range of a 5x return. So in other words, if they have a business that they purchase valued at $1 million, they want to grow it to $5 million, and some even higher than that point. You want to be very aware of what that exit strategy formula is that private equity group is looking to do. There are a multitude of exit strategies that different ones look at. Some look to hold the company indefinitely. Those are rare, but they do happen. Other ones are looking to scale the company to a certain level and then enter it back into the marketplace and sell to a higher level private equity group or maybe an investment bank. And in the third tier, which normally isn't in the first entry level of the mid-market, is going to be those that look to scale a company to eventually take them public via an IPO or a DPO, initial public offering, direct public offering, private placements, stuff like that, things of that nature. But in most of the Main Street business sales to mid-market, usually, I should say micro mid-market, is going to be up to about $5 million in sales. Those are typically going to be one of those three buyers, which is the individual buyer looking to purchase for their own accord, running it as their day-to-day job for their own income. The second one is the passive individual or individual trust that is looking to purchase that business. They're going to require a higher level of earnings to support the debt and the manager or the operator that they're putting in to run the day-to-day operations. And the third one is the private equity group. Once again, that is such a large topic in and of itself. It's a little above just the scope of one video, but I'll do another video on that. Hopefully this gives you an idea of who will buy your business. So now that you know who will be looking to purchase your business, we can go ahead and learn a little bit more. So if you're interested in that, there should be a link below to click. It should say learn more, and let's go on to the next video.